If you've been paying attention to the news recently, you might have seen that the Reserve Bank of Australia and APRA, which is the bank's lending sort of regulator, has basically come out and gone, the property market across Australia is far too hot, and they're basically looking at putting some water on it and cooling the fire. Now, they spoke about a number of different ways to do this, and one of them obviously would have been increasing interest rates, but that has broad effects on the economy. So they've decided to go down the path of basically limiting people's serviceability, and they've done that by essentially increasing the threshold interest rate. So essentially when you apply for a loan, they don't just look at your loan and your serviceability at the current interest rates, they are stress testing that. And the way the banks have gone about it, and the way APRA has gone about it, has essentially led to a 5% reduction they're talking about on actual borrowing power. One of the interesting metrics that they were talking about throughout this process and throughout the news articles that were getting released as APRA were looking at different tools was debt to income ratios. And they spoke about these high debt to income ratio borrowers. So that's people borrowing over 6 times their income, and really started to draw a line around that 6 times income mark. And we're really starting to refer to this as a bit of a rule or a bit of a line in the sand per se. So it got me thinking, got me looking at sort of debt to income ratios and what exactly that looks like at 6 times someone's income. And it really is quite a good guide, and a guide that you can use in different towns and different cities and look at ABS data and look at the average wages for those areas, and then extrapolate out and look at different house prices. So just a little bit of a hint there at different ways you can research an area using ABS. But what I really wanted to look at today was the Australian averages and what that will impact on prices in different regional areas coming into the future. So recently news.com put out an article saying that the average Australian wage has ticked over 90,000 per year. So that's some pretty astronomical growth there for the Australian wages, and they're saying that the average wage now sits at 90,000. Now, important note here, this is the average, it's not the median. Quite often there is a huge difference between the average, which is all the wages divided by the number of people, versus the median. Essentially what we do see is there is a big section of high income earners that earn 5, 10, 15, 20 times the national average, and that does drag the average price up. But as it sits at the moment, the average income throughout Australia is 90,000. And essentially I wanted to look at what this essentially means that the average person can borrow. So at 6 times their income, the average person can borrow 540,000. Now if you've got a couple buying together, this essentially doubles to 1.08 million, so 1,080,000. So that starts to give a bit of information and a bit of a guide to Australian property prices and where they might likely be heading into the future. So if we start looking at different prices in different areas, we soon start to realise that the Melbourne and Sydney markets are very close to those limits. Yes, people might earn slightly more money in those areas, but with those lending limits and with that 6 times debt to income ratios, looking at average incomes, you can see that those $1 million price points, while they might be sustainable at the moment, and I'm certainly not saying they're going to drop, I think the chance of them continuing to grow is very, very limited, as serviceability is going to become a real challenge for the average person to be able to afford it in those areas. Where if you look at your regional markets, and when I say regional, I mean like regional cities like Cairns, like Townsville, like Mackay, these sort of regional cities, many of the price points are still averaging around 400,000 to 500,000, and with the income still around close to that 90,000 mark, you can see why these areas do have a lot of growth of potential and are areas that I'm strongly considering buying in, as the serviceability is still there and people aren't pushing those debt levels. So I think a big thing to look at here, I think when it comes to banking and government regulation around property, I think when they pull one lever, it often pulls another lever just as hard without them intentionally trying to mess with that thing. So when we look at serviceability, the people that are going to be hit the hardest here are single people and first home buyers. Normally first home buyers are younger buyers, they're not as far along in their career paths, they're normally earning less money, and this means that when serviceability becomes harder, it's harder for them to meet the criteria to borrow the money they need to get into a certain market. And this is the same with single people. Obviously, as a couple, you've got twice the lending power there. So as a single person, it can be really hard to crack into the market, and you combine that with a first home buyer or someone on a lower income, and it really can start to lock them out of buying property in Australia. Where the reverse side of this is, as people have a higher income, they're obviously going to hit those serviceability targets easier, and they're going to be able to buy 1, 2, 3, 4, 5 investment properties. And this will in turn sort of drive the property market up and really hold those first home buyers and those single people out of the property market unless they've got substantial incomes there to meet the serviceability needs. So what are some predictions that we can draw from these serviceability changes? Well, first and foremost, I think investors are going to start shying away, for lack of a better term, from those Sydney and Melbourne markets. I think the growth potential isn't there compared to looking at the regional markets. At the end of the day, for an average $1 million house in Sydney to go to $2 million is a massive jump, and would really need to see income skyrocket for that to happen. Where for a $400,000 house in a regional area to go to $800,000, I think it's a lot more likely. And essentially, you're still seeing the double. So that's sort of, I think, where investors are going to start looking, especially when the rental returns are so good in those regional sort of areas. So that's my first prediction. I think we're going to see a lot of investors moving away from the Sydney and Melbourne markets and moving into regional areas. My second big prediction is we're going to see first home buyers in particular really struggle to get into those higher price point properties. Essentially, their serviceability is not going to be there, and this might in turn lead them to contemplate moving away from Sydney and Melbourne and those big capital cities, and in turn look at the regional areas as a place that they could move to essentially fulfill the great Australian dream of owning property. So I think we will see that younger generation really consider moving just so they can actually get into that property market and start feeling like they're moving ahead in that direction, if that's what they desire. The third big factor, and while there is some bigger income earners that can afford to buy 3, 4, 5 properties, I think there'll be a lot of mum and dad investors that simply won't meet the serviceability needs in order to be able to buy an investment property. Now, what this is going to do is essentially dry up supply on the rental side. So while there will be some investors that will move into regional markets to take advantage of the cash flows on offer, I think there will be a certain amount of people that will simply hit their serviceability limit, and this is going to stop them buying investment properties. And once again, this is going to have a real impact on those low income earners or people that are choosing to rent, as the lack of supply coming to the rental market is then going to drive rental prices up. So it really is a two-edged sword. We limit serviceability, which might somewhat limit capital growth, but it's also going to limit people investing in property, and this essentially is going to create a shortage of housing, especially in the rental market. So like I say, I think there's a real balancing act whenever the regulators step in and try and play with serviceability, try and play with the property market to either slow it down or speed it up, as it's very hard to have the actual desired effect happen. If you do slow down one thing, it's going to increase another. Like for instance, like I'm talking with serviceability, we might slow down capital growth, but then we might create an even further rental problem. So it really is a two-edged sword, and short of creating new houses and building new properties in an area, there probably isn't too much of an answer to the housing problem we are seeing Australia-wide at the moment. So that's my thoughts. I hope you enjoyed that video. Hope it made some sense to you. If you do have any questions or are interested in investing in property in the Cairns region or looking at buying or selling, absolutely reach out to me. I'd love to have a chat.